Get yourself a cup of coffee and let's talk about stocks. And let's talk about this stock market that started this week on a down note on the Nasdaq as well as the S&P. The, the Dow stood up tall. It was up, and I believe the Dow celebrated its highest level ever, which is good to see. The Dow is a little weird because it's only 30 stocks and it's very well known companies, but it did well. So, congratulations to investors that have Dow stocks. I am Victor and I operate Victor H Investing. I'm more of a long term investor. I'm looking for companies that are really desirable. These are companies that are going to be much more valuable over the next 5, 10 years. I hope to double the stock price over the next 5 years. That's the goal. Some stocks do better than that, some stocks lag. But in general, my philosophy is to try to really find quality companies, be a part owner in that company, buy stocks preferably at a discount, although very high quality stocks could be bought at fair price if it's the right stock, the right company, you really believe in them. So that's my investing philosophy. I do deep dive analysis, which I am willing to do on this live stream. If you have a company you want to dissect, take a look at, we'll look at the financials. We'll break it open and see what's inside, see what kind of value that company has. If we look at free cash flows and we look at a net present value of those free cash flows, we add the cash on the balance sheet and take away debt. That's how I get to free cash flow value for a company, and willing to do that on the live stream. So if there's anybody out there that has a stock that you would like to analyze or for me to analyze, please suggest it in the chat. We'll take a look at it. And I also look at earnings per share, especially for younger companies. Earnings per share tell you about that company's profitability. Of course, top line growth is really important for a company, but that earnings per share could really reveal that a high growth company is headed in the right direction. So I like looking at earnings per share so that I don't disqualify younger companies just based on free cash flow. So that's my philosophy. I hope you're a returning guest because you probably got a little bit of taste of how I do things and the value that I can bring the investing community. My intent is I've been a long-term investor, and we're in the golden age of investing. We get to interact with one another, share ideas, share knowledge, learn from one another, and it's great. I've read books. I started reading books 30 years ago. I read up on all the great investors 30 years ago, and frankly, I did follow their advice and paid off well. Overall, I have a good foundation of knowledge, but it really became fun when we started streaming and recording videos and sharing with one another. It really became fun because investing could be a little bit of a lonely task. You invest in a stock and you're watching it a little bit in privacy. At least 20 years ago, it certainly felt that way. You really believed in a company, you invested in it, and if it worked or if it didn't work, you had nobody to share that with. But now you got lots of investors online that you can share it with. You can find like-minded investors that maybe are really interested in a particular company and industry, particular trend in the market. And so it's the golden age of investing where we could really, if anything, provide some support to one another. But I think we can learn from one another. I've learned a lot on YouTube. I come with a little bit of education. I've got an undergraduate in accounting. I worked in keeping the books for publicly traded companies. I've worked in the software industry, and I also have a master's in business. Really enjoyed the curriculum. But online, I really see that some real top pros share their experiences, and that's really cool. I really like watching that. I like learning how other investors do it. There's not one way to invest. There's thousands of ways. My way works for me with the objectives and the outcomes that I'm looking for. So everybody, thanks for joining. I appreciate it. Looks like Doomy Trash. How you doing, Doomy Trash? Thanks for joining. I appreciate you joining. And again, everybody, if you've got a stock you have in mind that you want to take a look at, please suggest it. If you want to take a look at other ways of seeing my content, I'm on YouTube. If you want to engage, I'm probably most active on Discord. Community investors that follow me on YouTube primarily, we engage in Discord. There's that information. I've been on Facebook for a while, and I've got a group of investors that follow me on Facebook. There's those details. And I've got Threads. I didn't put X on there. I'm on X, but X and Threads, I don't do a whole lot on. I'm basically just publishing out like what I'm doing on YouTube or on Stonks there. So, and of course, I'm on Stonks, and we'll be streaming each morning. I think I'm a morning guy. I like drinking coffee early in the day, get my head around the stock market. I don't trade in the first half hour of the market. I tend to let the market kind of sort itself out, and then I buy probably midday or toward the end of the day. It tends to be my habit. And so I'll spend the first hour with you guys this morning just to see where this market's headed, and hopefully we get into an interesting conversation. And I'll be here on stocks each trading morning, so I'll be here all week, 5 days. Next week I've got good news for you. We get Monday off. I don't know if it's good news or bad news. If you're a stock market junkie like me, it's almost bad news. Like, what? We don't get to trade on Monday? What the heck, man? But yeah, we get Monday off. So maybe go to the beach, enjoy yourself. No trading on Monday. Of course, if you're a crypto trader, that's a 24/7 occupation. So, all right. So, enough of that. Let's take a look at the markets and see what's going on Wall Street. So, the futures, we've got the Dow is set to open a little lower, S&P set to open a little lower, the Nasdaq a little lower. I don't always buy into the futures, but I would say that following a down day on the Nasdaq and the S&P, it's a little bit of maybe people are still feeling a little grumpy, and maybe we'll see. I'll tell you in 2 hours if the market's going to be low or high. Oil is down, which is I'm keeping an eye on oil because it was up 3% yesterday, and the oil complex really does have an effect on the rest of the stock market. And I do own a big oil stock, so I keep an eye on it. It's down 1%, so the tensions looks like in Israel are kind of calming down a bit, and hopefully it does calm down. Not a lot of people get hurt, so oil is down. No big earnings. I think after the market closes, Box is going to announce, and Stonks is going to have a contest after the market closes. $1,000. I mean, put in your guesses and see if you win some money. But it's going to be on Box, and Box is primarily a storage software company that you can store whatever pictures, content, and so forth. And we'll see how they do. I'll take a look at Box as part of this live stream just to see what I think of this company. And I'll save that for a little bit. I'm not going to jump into it right away. All right. The thing I also wanted to comment is, I'm an investor primarily in real estate and stocks, and that's where most of my net worth is at. But I also have other investments. I have crypto and I have bonds, and bonds really play an important role, which is my bonds are way more stable and less risk than stocks, and they take care of potentially my living expenses for the next 5 years. I've never had to tap into that reserve, but I like taking the next 5 years off the table and saying, hey, my living expenses are handled for the next 5 years. And today, yields are up. I watch this because when yields are up, that means that bond prices are lower. When bond prices are lower, there's a better acquisition price, and I can add to my bond position. So I like looking at that. Bonds are far easier to me than stocks. They're loans. You're making a loan to a corporation or a government, and they're going to pay you an interest rate. Yeah, and so I'm probably going to buy some bonds today, just maybe a couple $1,000s of it, and keep adding my bond ladder. And if you want more information on a bond ladder, take a look at my channel on YouTube. I've got a lot of details on a bond ladder, but I take a look at that as well. All right, so interest rates are up. No other big news to report. Now, I see that Doomy Trash wants to look at a couple comments. Doomy Trash says, I was wondering what's your view on you. All right, we'll take a look at you. and HIMS. Okay. So we'll take a look at you and HIMS. And we'll start off there. I'll kind of prioritize viewer request. And then just to give you a preview, I'm going to look at lithium stocks in the Discord that most of the investors that I interact with are on. Interesting conversation came up on lithium stocks. So I thought, you know what? I'm going to do a little deeper dive. I've got 4 companies, and then within the lithium kind of, I guess, complex or ecosystem, and we'll see if lithium stocks are looking better and better. The prices have been falling, and boy, the world needs more batteries. Their demand is super high for lithium batteries. So let's take a look at the lithium stocks, and then I'm gonna look at Box. I'll look at Box probably toward the tail end of the live stream, just to kind of see where that stock's at. I'm not going to make my guess until probably around 12. That's when I usually put in my best guesstimate on what price it's going to be. And so that way we'll cover that. All right. So we're going to look at you first. So you is clear, secure. So the stock, maybe it IPO'd or something, but over the last year, it's up 33%. It's had an awesome month. It's up 39%. Interesting. Okay. So we look at you here. It's a $2.7 billion company, revenue of $697 million. What do they do? Clear Secure operates secure identity platform. Clear, primarily United States, secure identity platform. Yeah, I've noticed these guys at the airport. So if you subscribe to their service, you get priority. You get to you get not cut in line, but you get a different line that is pretty expedited to get to the terminals. So I'm familiar with them. Okay, well, these guys are in the right space. Man, travel's through the roof. I don't know if you guys have been to an airport lately. Look at this freaking stock appreciation. Maybe that's because there's so many travelers. They're making a lot of money. They are profitable. Their P is a little high at 37. Forward P is going to come down to 20. It's a buy, but it's fairly priced, right? Only a 1% discount. When we look at their financials, man, impressive growth. They are small, but it's still impressive. Okay, very good. Growth is good. Top line tells me, customers want more of the product, and they're expanding their products. Now, free cash flow looks really good. I like seeing this where you have increasing cash flow over time. To me, data or a trend that shows upward trajectory, for me, there's more confidence in that. Look, they're making their business bigger. It's more profitable. It generates more free cash. So that's a very good trend to see. So we got 269 million of free cash flow in the trailing 12 months. We have a nice growing business. Let's check to see if they have too much debt. If they have too much debt, it may be a deal breaker for me. But they have $669 million of cash, and they have $124 million of debt. So really, they don't have debt. They can pay debt off immediately. They can write a check. Okay, there you go. Lender, go away. But they don't have to, especially if they have a low rate. So this one's looking good. So let's get into a deeper dive analysis. Let's get into these financials and see what this company is worth. So I have some security companies. I'm going to put these guys next to everybody's favorite company that caused the biggest computer outage in the history of mankind, CrowdStrike. I sure did CrowdStrike and made some money. Got in, got out 10 days. Thank you very much, stock market. But now we're going to look at our friends at Clear, which is, the symbol is a little weird, right? Ooh. It's a little in your face. It feels that way. Maybe it's because it's a little early. It's a little early in the day for me. I thought I said I was early guy. Okay. So this is a small company. Small companies, I believe, are higher risk. So I'm going to increase the discount rate. I want a higher rate of return for my investment because I'm taking a higher risk. Okay. So we're going to do that. I'm going to decrease the size of this column so I get a little more real estate for you guys, and we'll keep rolling. Okay, so the free cash flow that we saw was for the trailing 12 months was 269,220,000. That's going to be the starting point. This is like the trailing 12 months. And I could actually increase it by its growth rate, but I'm not going to. I'm just going to go trailing 12 months just to have a first cut what I think the value of the company. They're growing really nicely. Okay. So when we talk about the first 4 years, I'm going to have a growth rate, and then the terminal value is going to have a growth rate. And the growth rate, 25% might be a little rich. If you look at the most previous year, right, we went from 200 to 270. That would be 30%. I'm going to say they're going to grow by 20, and then 5% growth rate. Security, airports. Yeah, okay, we'll go with that. So that really puts a valuation of all the potential free cash flows in the future at 4.5 billion. The cash on the balance sheet was 600 and some odd thousand. Let's go back to that. So the cash on the balance sheet, 669,620. So 669.62. All right. And then total debt is 124.62. So I have a net present value of their cash flows discounted at 10% is 4.5 billion. I add cash, take away debt to get to what I call equity value. And I compare that against their market cap. And their market cap is 2.69. So it's $2,690,000,000. The shares outstanding are 93.16. Stock price is $28.86. So based on free cash flows, this is a highly discounted company that is a high growth company. It's a small cap. I happen to think that right now I'm looking for small caps and healthcare companies. I think they're going to do well for the remainder of 24 and into 25. So this thing's looking pretty good, pretty darn good. We have 5 analysts covering this small company. They say it's fairly priced. Let me take a look at their earnings per share. I like doing my own analysis. It's my money that I'm investing, and I like to know the numbers. So $1.28 per share is expected. So let's put that into the earnings per share. Now, I'm not going to hit them with a 36 PE. It's a high growth company, but it's a small company. So I'm going to go 25. They're growing their earnings per share expected at 20 and then 14. I never take the full amount there. So I'm going to say 12%. So I get to $35 a share. Current share price is 28. So this company is really attractive. It's a 67% discount on a small cap. And of course, we're showing up to the party a little late on this one. All the party goers that got there ahead of us, they're sitting on a nice 49% gain if you bought on August 2nd. So not a bad return for 1 month. But this thing's got more to go, according to their valuation. Man, I wish we had this live stream a month ago. And I wish Doomy Trash would have brought this stock up a month ago. But if I'm going to start wishing, I've got wishes that are far better than that one. Very good company to suggest here. I'm going to put this guy on I'm going to do more analysis list. I might publish a more deep dive video. But this is a valuable business. This one's got all the right makings. They've got very little debt. They got high cash. They're generating more cash. They're growing their top line. They're profitable. It's like, man, this is a good little company here. And they're in a space where I think the reason they're growing is the airline industry is experiencing record number of travelers. Records. Like, boom. Shattered them. And these guys are probably getting a lot of subscriptions because travelers like myself are probably looking at that line, going, oh, great. I have to wait, 30 minutes, 45 minutes to go through security. Or if I become a Clear member, I go through in 5 minutes. That's not bad. If you're traveling a couple times a month, that's a no-brainer. So you can definitely see that there's a value proposition there. And I would imagine that maybe these guys are going to start getting into stadiums and stuff because security's tight everywhere, right? As it should be. I don't want, bad stuff to happen, terrorism, all that stuff. So they might start getting into stadium security and having, like fast track kind of lines that are clear, secure, supported. The stadium wing, because they're like, hey, cool, you're gonna reduce the congestion at the check-in. But neat little company. I'm gonna break them apart and put them back together. Probably spend a couple hours of analysis on them and take a look. But that's a really good idea. Thanks, man. Right, let's go over to hymns. And I am familiar with hymns. I will share my general comments at the end, but for now, you can see that their stock has really had a lot of movement. It's up 134%. Incredible. Awesome. Okay. Now, when we look at hymns, let me reacquaint myself with this company. Hims and Health operates telehealth platform that connects consumers with licensed healthcare professionals in the United States and internationally, offers a range of curated prescription and non-prescription health and wellness products. So it does make it very convenient to get, certain medications. And I bet they're probably getting a lot of that weight loss stuff, or medications, through their platform. So it is a company of the times. So it's a pretty good business for the times. They do a lot of generics from what I saw. They're headquartered in San Francisco. Okay. That's who they are. Now, when we look at it, the market cap's still small, 3.5 billion, revenues 1 billion. So that's pretty good. They are profitable. Okay. PE is only 196. That's a really high PE. Forward P is 57. That's still very high. It's a buy, and it's discounted by 29%, according to analysts. It has had a pretty strong pullback recently. Let's take a look at the financials. Man, I see a lot of green on the screen. Look at that growth. And they're $1 billion company. Interesting. So they're growing nicely. Just to take a peek at the quarterly, even the most recent quarter, 51.8%. Damn. Go Hims. Growth company. This isn't healthcare. I like healthcare stocks. Man, do me trash. You're making my day, buddy. I like right now, I like healthcare stocks and I like small caps because, technology, I love technology stocks. Made a lot of money on them, but they're really priced high. And I love my Meta stock and I love my Alphabet Google stock. But man, they're priced really high. And I think that small caps are discounted, healthcare stocks are discounted, and they have a very nice next 24 months ahead of them. So you have suggested, you started off with a really nice suggestion on which is a software security services company. Bingo. I think that one was worth taking a look at. And now we're going into healthcare. So you're 2 for 2, man. All right. So revenue growth is very good. Again, I like looking at revenue because revenue tells me the health of the business. And I don't know that a lot of people would argue with me. Free cash flow, 100 million. Okay, so not the biggest amount in the world, but 100 million is 100 million. And let's make sure the balance sheet is in good health. Cash, 227. How much debt? 11 million in debt. Very good. Healthy balance sheet. So we got a growing business, produces cash flow, profitable, quality balance sheet. All right. So let's kind of put this guy in the analysis. Now I got lots of healthcare stocks. So this is going to be you. Let's just go ahead and copy this guy. And I'm going to put it right here. I created this model. I created it based on the principles that I have been taught, I have learned, I've invested, I have used, I believe, I understand. And I created my own model. I don't use somebody else's. Not to say that other people don't add value. I'm just saying that my the way that I think is if I don't understand the numbers, I don't understand the company. So I have to know every number. And that's just the way I am. I guess my accounting training taught me that. It's my money I'm investing. It's important to me that I really understand an investment. So I created my own template. It's on my YouTube channel if you wanted to download it, but let it serve as an example, not necessarily just to use it kind of blindly. I would encourage you to build it yourself and really understand every number. All right, so we're talking about hymns, and this is Hims and Hers. Small company, I'm going to leave that 10% because it's a small company. They were at around $100 million of trailing free cash flow. So let's look at their trend, right? Now, remember, we just saw you, and they had like positive, 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 and it was an upward trajectory, which was beautiful. Now, this one is good, but not great because it was negative, 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 positive for one full year, positive in the trailing 12 months. So I'm not as confident about this free cash flow as you. You showed me that, hey, 4 years ago, positive cash flow, 3 years ago, 2 years ago, 1 year ago, and I'm very confident. This one has been cash positive for about a year and a half, but it's still cash positive. So 100 million is their trailing 12 months free cash flow. Since I don't have as much confidence in that trajectory, I'm going to grow their cash flows by 10% and 4% on long-term growth. They're just not showing big muscles when it comes to generating free cash flow. So I'll leave it at that. Their cash was $227 million of cash. And they had very little debt. I think 11 million, right? 11,480,000. So the equity value is 2 billion. The market cap for this company is 3.48 billion. Shares outstanding are 217. And value per share is $9, but their shares are trading for $14.79. So if we look at cash flows, and based on a cash flow forecast that I believe in, and this one's kind of there, right? Give or take 10%. They're being priced at a premium of 37%. Okay, now let's look at earnings per share. So 12 analysts covered the company, and they're saying they're going to do 24 cents per share. And it's good that we looked at you before looking at this one because you see a difference, right? You's more profitable, yet they're a smaller company. They produce more cash flow, yet they're a smaller company. So it's good to see multiple companies and then say, hey, I see the best one. I see the best one in the pack. Now, these guys are growing. I'll give them that much. I'm going to leave it at 25. And their growth rate on their earnings per share is going to grow quite fast, right? They're going to go from 24 to 62 to 31. So I'll go to 25% growth. It gives me a stock value of $7.50. It's priced at a premium of 49%. So HIMS is priced at a premium, in my opinion, of 41%. And I think that HIMS is operating in healthcare. And healthcare, you have a lot of expense. And I think that's what's showing up in the earnings per share. It's also showing up in the cash. And I think they're doing something that's interesting. My worry is that HIMS is going to get themselves into a pickle because they do sell a lot of generics and they do kind of do a lot of marketing. And if people start getting sick for some reason, it may be blamed on them. I'm just totally, making this up, but I've invested in pharmaceutical for a long time and know that pharmaceutical companies are really careful. They do not want perception to be negative for the companies. So HIMS is a high growth company. They're $1 billion company. I think it's an interesting company, but I would not be buying the stock because I feel like I'm paying a premium, and we'll see where the stock ends up. I would be very interested in you, which is showing really, really phenomenal numbers that I'm interested in digging deeper and potentially investing, but I want to put a little more time and energy into my analysis there. Thank you, sir. Very, very good companies to take a look at. If there are any other companies that you guys want to take a look at, please suggest it. We will dive into them. But if there's no other requests out there, let's talk about lithium. It's not a rock band. It is a material that goes into batteries. Now, the demand for batteries, I don't think I need to convince anybody We got batteries and everything, man. We got car batteries that are quite powerful, like the Ford F-150 Lightning will power your house for like 2 or 3 days if you had a blackout. Um, so batteries are, I mean, the demand is just huge, and then China is going to start cranking out EVs. So the amount of lithium demand is really going through the roof. So I have a string of 4 companies, and I'm going to kind of do a flyby these companies and see if this is a space that's ready to be investable or ready for me to consider an investment. So let's take a look at the first symbol is ALB. This company over the last year is down 52%. So what caught my attention here is, so we need more batteries. I don't think anybody's going to argue that. But why are these stock? Why is this stock down? So we're going to compare that one to. Let me compare them all. These are my four amigos of stocks that are going to be analyzed on this little clip. And this one's ENVX, and we're going to look at each one independently to see which one is the best one in the pack. Maybe there's 2 that are really good in the pack. And then maybe one of them is investable. Maybe. Don't know yet. All right, so we got these 4 companies. A couple of them are in Latin America. And then this guy here, I think, is in China. So you could see that the whole industry is on a downtrend. It looks like this one here, ENVX, did have a pretty strong rally, and now it's faded back down. So to me, I like buying stocks when they're low and selling them when they're high. And I like seeing industries that are kind of forgotten. The stock market is, as I've invested over 30 years, the thing that is super interesting, right? Like my background is mathematics, accounting, software, very like, I forgot which side, left brain or right brain, whatever. But the emotional aspects of the stock market are so interesting. Sometimes the stock market sells off an industry and you're like, that didn't make any sense. Why is the stock market doing that? Again, we're looking at an industry where battery demand is going to go through the roof. We're going to have more freaking batteries around us than we can imagine. I'm doing a little project with my wife in the backyard, and she keeps me busy every weekend. She does all the thinking, I do all the working, and she got these solar lights, and she said 100 feet of solar lights, and you just hang these things. You don't have to plug them in. They just you hang them and you're good to go. And I'm like, man, we got batteries everywhere, and those solar, lights have like a battery pack to them and all that stuff. So we got batteries everywhere, even in the backyard, and of course in cars and in phones and in computers and so forth. So lithium is gonna be with us. So in a big picture, I'm kind of curious, and I might be interested in investing. But let's take a look. So the first company is this company, Albie Marley Corporation. They're headquartered in North Carolina, I believe. And this is a U.S. company, $10.45 billion company. This stock is down 53%. Their revenue is $7.4 billion, which is almost up there with the market cap. What's interesting is they lost money. Okay, that could be a problem. Why are they losing money? Forward P is 90. That's very high. They pay a dividend. Why are you paying a dividend? If you're in a growth industry, don't pay a dividend. Pay a tiny dividend if you're going to pay a dividend, but keep your cash and grow your business. I don't need a dividend. A hold, but it's discounted by 37%. We look at their financials. They did have a big, in the trailing 12 months, they're losing revenue. There's red on the screen here. Red is like a company is bleeding blood. And this has to be explained. This is a big drop in revenue. What happened is I think the commodity prices are lower. If my good friends on my Discord, they provided nice graphs. And I think lithium prices have dropped. And that could be a temporary situation that is going to improve. So I still may be an investor. I have materials companies, and I'm okay investing because I like investing when stock prices are low, knowing that in 2 years they're probably going to be much higher and I can double my money in 2 years. Okay, great. That's okay with me. So I'm going to kind of dig into lithium prices and see where that forecast is going. But before we do that, let's kind of do a quick valuation. We look at cash flow for this company. So they're doing negative cash flow. Okay, this and this is quarterly. Okay, let me go to the annual, do trailing 12 months. Negative cash, negative cash. So this one here, I'm not liking what I'm seeing. It's not profitable, no free cash. So I'm going to park this one because I can't get you a value. If a company is burning cash, I'm like, okay, well, I don't have a lot of value for that company. Now let's move over to ENVX. ENVX develops, designs, manufactures lithium-ion batteries. It serves wearables, so forth and so on. And let me take a quick profile look. These guys are in Fremont. Okay. Their stock price is down 24%. It had a pretty strong rally and then it faded. Okay. They are a $1.85 billion company. The revenue is only 16 million. Whoa. All right. So it catches me by surprise because you're paying 100 times revenue for the company. That's a very high price to pay based on revenue. But these guys may have like a plan to be super important. Their net income is really bad. They lost $238 million, yet they only had $16 million of revenue. So these guys are probably super early. It's a strong buy and they're discounted by 100%. Okay. So yeah, they have very low revenue. These are not my favorite investments unless it's in an industry that I really, really know well. This is not one of them. I'm not a lithium kind of, I haven't worked in lithium. I haven't had a lot of experience. So this one is not gonna float my boat. So I'm gonna move on to the next one. So this one's iffy. This one's an absolute no. Now let's go to Sociedad Química y Minera de Chile. All right, so these guys are down in Chile. I'm okay with that because I don't have an investment in Chile. I have one in Mexico. I used to have one in Brazil, but I sold StoneCo, so I'm not in Brazil anymore. So I'm cool with Chile. Chile has always been kind of, with regards to Latin American countries, it's always been one of the wealthier countries because they have so many darn minerals. And it looks like they have lithium. They're down 38%. So market cap of 11 billion, revenue of 5.5. So you're paying 2 times revenue. Okay. PE 410. Holy smokes. But forward PE is 10. Okay. I guess we're expecting lithium prices to improve. They have a high dividend. And again, I'm like, why are they paying a dividend? But that's just me. Buy, and it's discounted by 50%. Okay. So we're seeing that lithium prices are probably not good. But when lithium prices are good, these things scream up. So this is looking interesting. Now, knowing that lithium prices are bad in 23 in the trailing 12 months, what I would do is I would analyze the years when lithium is good. And I'd probably take an average of the cash flow versus saying, okay, well, I'm going to use the trailing 12 months, which is 438, because that's not going to reveal, a company that's cyclical like this, that has a commodity that goes up and down. I have to pick what I would expect over the next 10 years. And over the next 10 years, I would expect they're going to have a couple good years, couple bad years, couple good years, couple bad years. On average, do they have positive, right? So if I took, let's say the last 4 years, I'd probably take the average of that and use that for my valuation and then get to a value of the company. So I might do that on this one. So this one's looking okay. And then balance sheet, let's make sure it doesn't have a bunch of debt and is undesirable. So they're 2.1 billion. Is this dollars? Yeah, $1 million. Okay. So 2.1 billion and total debt's 4.5. So net debt's like 2.4 billion. If we look at EBITDA, because we want debt to be less than 3 times EBITDA. EBITDA is close to 2 billion. So yeah, they can pay debt off in roughly a year and a half. So that's good. We don't want it to be above 3 years because then it's just too much debt. They got to work for 5, 6, 7 years just to pay off debt. It's like, man, that's just too long. Okay, so this one looks somewhat interesting. And then we have the last contestant, Lithium Americas Corp. and engages in exploration development of lithium properties in the US and Canada. So this is more of a miner. Okay. So has a market cap of 602, doesn't have any revenue, and it's losing money because it's probably exploring. Um, yeah, they don't have any revenue. They just have operating expenses. So this is totally a man. If they strike a big deposit of lithium, this thing's going to go through the roof. If it doesn't, they're probably going to have stockholders take a complete loss. This is not my investment. So I'm probably going to take a look at this guy here and go on a deep dive and probably record a video on my channel for this guy, because this one's, to me, this is the best one in the pack that I'm willing to invest my time and energy into and see what I come up with. I'll probably take that cash flow over the last 4 years, full years, add all 4 years and divide by 4. That'll be the average. Say, okay, that'll be a reasonable expectation over the next 10 years, and I'll grow that by a low amount, maybe 5%, and that'll be my cash forecast. With earnings per share, I didn't look at earnings per share with this guy. So they are going to have a positive earnings per share, and it's really going to jump up next year. I guess they're expecting lithium prices are going to recover, so that looks interesting. And based on that number, that's why I think analysts are saying it's really discounted. So this one might be interesting. I'm going to take a look. There's a couple of reasons why I'm looking into this company. First, the big picture makes sense to me. Like, hey, we need more batteries. Lithium's going to be in high demand. That makes sense to me. Okay. I can understand these companies are going to do well. Second, I don't have any companies that look like this in my portfolio. So this would be, a good addition. It would give me a little more diversification if I buy quality. Nothing wrong with that. And I'm buying at a time when it's a good time to buy, because these stocks have been discounted. So buy when they're discounted and then watch them rise when the commodity price goes up. So I'm okay with that. So I just went through a kind of a thought pattern, a train of thought on lithium companies. Hopefully you found it interesting. Let me know in the comments if you want to go into any other stocks. Let me check the comments here. No more comments. Looks like we got 20 viewers. Thanks so much for tuning in. I appreciate it. Now let's take a look at Box. So Box is you can put them in the category. I think they're in infrastructure technology. That's correct. They do storage, and they probably do storage for, like, if you go to a website and they provide a service, you can store everything on Box, which is cloud-based storage. And it's I think 10 years ago, maybe 15 years ago, it was quite valuable. It was like, wow, these guys are ahead of the pack. The one thing I would say is the infrastructure companies, the big ones, AWS, Azure, Google Cloud, they do exactly what Box is doing. Now, Box is tiny compared to those guys, but that will constantly be a threat. Companies may want to just have one hyperscaler, one infrastructure partner, and that might be a bigger partner. It might squeeze Box out. We look at their company. It's a $4 billion business, $1 billion revenue, and the PE ratio is 39. That's a little bit high for this type of company, and I'll get to why I think it's a little high in a bit. Forward P is 17. Analysts say it's a buy, but it's only discounted by 6%. I don't like that recommendation, because it's like, tell me it's a buy if it's like discounted by 30%. You can see growth is slowing. So in the quarterly, it's up 5%. It's better than the quarter before. But these guys are a small business, right? 1 billion compared to the behemoths, right? Google's and AWS, Amazon. Those guys are massive, and they're growing 10, 20%. So why are you only growing 4.6%? You're a $1 billion company. So that top line revenue growth, not a major concern, but I'm like, okay, this is the wrong trend. You should continue to grow. If your product is, really desirable by the market, you're getting more customers. Those customers you have like the product so much, they're buying more of it, or maybe you can cross-sell other things. I'm not seeing that here. So that's an element of the desirability of this business isn't very high. Their free cash flow is 324 million. It's very good. You can see their cash flow has been increasing. That is impressive. Okay. So if I took 3.24, 324 million, this is a slow growth business. And I have a back of the napkin kind of calculation. If it's a growth business, I can multiply it times 20, even 30 if it's high growth. Slow growth, I might multiply it times like 15, and we would get to about a $4.6 billion valuation, assuming the balance sheet's okay. And their market cap is 4.15. So this one is discounted. Let me take a look at their balance sheet. I'm sure their balance sheet's going to be good, but cash is 566 and total debt is 485. So they have net zero debt because they have more cash than debt. So they offer like a 15-20% discount. The analyst, 9 of them cover it. And earnings per share is decent. It's going to grow a little bit. Now, I own a string of software companies. For example, Adobe. I have Zoom, and a couple of others. And I have noticed that software businesses are really feeling the pinch. And I think a couple of things is the economy, right? I think businesses are beginning to tighten the belt and reduce spend. So they're feeling it. And of course, the AI interest, right? Businesses are saying, okay, well, let's not spend as much on software because we want to, dabble in AI to some extent. Or at least that's their perception. So software stocks have not rallied very well. And historically, software stocks are excellent. But this is an industry that I've worked in for a long time. And I think Box is very vulnerable because they're somewhat of a one product company, which is, storage. And that's what they do. And that's very exposed, vulnerable to the larger companies. Larger companies can grow and just take over. Customers don't want to have 20 different vendors when it comes to cloud-based infrastructure. They want a couple. And if they had to pick between Box and AWS, they'd probably go with AWS because they're like, well, Box, you can't do everything else AWS does. So I think they're vulnerable. And this isn't a stock that I believe is going to double in value. Over the last year, it's down 5.81%, which is somewhat expected. This is what I've been seeing software stocks do. Now, if I felt this stock could be worth twice as much like it's done over the last 5 years, I'd be a very interested participant, but I just don't believe that in Box. And I have other software companies in my portfolio. For me, it's a pass. For somebody else, it might be interesting. They may not have any software companies in their portfolio. They may think Box is great. They really like the company, and that might be a good investment for that person. But for me, it's a pass. And my best guess is where the stock price is going to land after we close. Let's see here. So market is opened. And the NASDAQ's down 0.36, Russell's down 0.62, so small caps are going down. S&P's down a bit. The Dow is down a tiny bit. I mean, if we stay at these levels, I'm going to guesstimate that after hours, I don't know, Box is going to be around the same price, 28.69. That'd probably be my best guess because they're going to announce after hours. Yeah, I guess I'd probably say if we're going to have a down day, I'd probably say it's going to go up 2%. That's going to be my guess because I'm going to be counterintuitive, which is if the market goes negative all day, there's probably be a little pent up like upside interest. And I'm assuming Box is going to come in with their 5% growth. Hey, we grew, we're profitable, free cash flow, and the stock will probably rise like 2%. So that is Box for you. All right. So we have opened the stock market together. Let's take a quick peek at what industries are making it happen today. So today, the best sector to be in is financials and healthcare. I like healthcare. I like small caps. Healthcare is keeping its head above water. And why is staples? So consumer staples is keeping its head above water. but I don't like consumer staples. The overall long-term appreciation is not good. So I only own one, which is a grocery store, Kroger, very well operated. I'm doing well with the investment, but that's enough. I don't buy too much consumer staples. I do have several financial services companies. Insurance is doing really well. My Robinhood stock's doing great. Coinbase is doing great. I have a couple of really well-performing financials, including Citigroup. Citigroup's done well for me over the last 2 years. Healthcare is keeping its head above water. Energy is a little below water. Materials, and then technology is taking the hit today again. It's interesting how things are playing out. I think the semiconductor space is really priced high, and investors might be feeling a little nervous. Like, hey, if Nvidia shows up tomorrow and puts out a bad number, oh my gosh, it's going to be like a hurricane of pain come Thursday. If Nvidia puts up an awesome number, that's what everybody expected. So it's going to be like a Super Bowl event tomorrow night. I'm going to tune in. I'm going to get my popcorn ready, and I'm going to go after that $10,000 that Stonks is going to give away. That's a big, big pile of cash, man. I'm sure you guys are thinking the same thing. It'll just be fun to be a part of it, man. It'll be really fun. All right, everybody. So we just opened the stock market. I'm going to get to the rest of my day. I want to thank each and one of you for attending. I really appreciate it. And I hope you found the content useful. Please drop me any feedback, either message me through stocks, anything that you think I could do a little better. Anything like, of course, if you ever want to analyze the stock, I'll be here tomorrow. I'll be here Thursday. I'll be here Friday. So if you're like, wonder what another investor thinks about, company XYZ, bring it to the live stream. Let's take a look at it. Let's beat it up. Let's crack open the financial statements and see what we find. See if we find a high value business. I like what we saw in you, and SQM looks like an interesting company, not quite as impressive as you, but I'm glad that I looked at you. One of the things that I've noticed in my live streams is, other investors are out there trying to make it happen for themselves, trying to create value for themselves and their families, and trying to improve their net worth. And in their individual, efforts, they revealed some really cool companies. You came up in the last week. I've seen you being a really interesting company, BTT, and then an oil services company. The symbol is Pump, Pump. And I released a video on my channel yesterday. And those three little companies are like, I would have never have seen those, but because I do a live stream and all these other investors that are out there participating in capitalism, trying to improve their wealth, trying to make investments that are going to pay off, brought those companies up. So I'm going to keep streaming, man. If you guys keep bringing up these companies, I'm getting return on investment on my time. So keep bringing it. Keep bringing these ideas. Let's take a look at them, crack them open, and see what we find. If you want to follow me on YouTube, got lots of videos on my YouTube channel. If you want to engage actively each day, Discord, and you'll engage with other investors that follow my community. Of course, I think eventually we're going to have something here on stocks, and we can use stocks. On Facebook, you can follow me there on Facebook, and then on Threads. Facebook is kind of like not very active. The investors there are pretty not active, but the investors on Discord, man, they're all over it. It's been a fun little exercise to do. And then YouTube really receives a lot of my attention because that's where a lot of this streaming session will end up there. But I do a lot of deep dives into a company, and then I put it out on YouTube. So you can find companies that I've analyzed in the last couple of years. And the library of recordings is quite large now. All right, everybody. I hope you have a really nice Tuesday. Good luck out there. Hopefully you make some money today, and we move towards Wednesday and after hours when we see the big, powerful NVIDIA announce their earnings. Everybody, take care. Thank you very much for watching.